It could be a terrible mistake to not add the majority of your net worth into a single investment. Hey guys, how's it going? My name is Charlie Marr, and in today's video, I'm going to react and respond to one of Warren Buffett's old videos from an annual meeting in 2008, where he actually talks about going all in, or at least adding a very large portion of your net worth into a single investment or idea. Anyways, without much said, I guess this video was inspired because I'm someone who doesn't diversify their portfolio much. I'm someone who's okay adding 70% of my money in one stock, or like all my money in like the top 3 stocks, or even going all in one investment. One of the response I get is just people calling me foolish, or I don't know what I'm doing, or that I'm gambling, or that it's dumb, or like you follow all these value investors and they would never do anything like that, and my argument is they would, and they have, and they recommend it. And for this video, I can preach and teach anything I want. I mean, I can say anything I want, but it's harder to believe me. So, instead of hearing it from me, why don't we hear it from these two amazing legends? So let's go ahead and get with the video. And as usual, I'll make comments here and there as we listen in. This is another great video, important video, but let's go ahead and get right into it. And the volume might be a little bit low, but we'll see.
Mr. Buffett, it's great to be here. I've read that there were several times in your investing career when you were confident enough in one idea to put a lot of your money into it, say 25% or more. I believe a couple of those cases were American Express and the Washington Post in the 70s, and I've heard you discuss your thinking on those. But could you talk about any of the other times you've been confident enough to make such a big investment and what your thinking was in those cases?
Charlie and I have been confident enough, if we were only running our own net worth, I'm certain a very significant number of times, if you go over 50 years, there have been a lot of times when you'd have put at least 75% of your net worth into an idea, wouldn't there?
Okay, so here's the first thing. The guy started off saying a lot of money, and he said 25%. Warren Buffett's out here saying 75%, which is actually pretty crazy. And I think that's it. That's all I was going to kind of note there.
Well, but 75% of your worth outside Berkshire has never been a very significant.
If you go back, he also said a significant amount of times, not just once or twice, a significant amount of times that he has put a large percentage of his portfolio into one investment.
Well, but I'm going back. Let's just assume it was. Let's just assume you didn't have Berkshire in the picture. There have been times, I mean, we've seen all kinds of ideas we would have put 75% of our net worth in.
Warren, there have been times in my life when I've had more than 100% of my net worth invested in things.
That's because you had a friendly banker, and I didn't.
Okay, so, that's kind of mind-blowing to hear from someone like Charlie Munger. So you heard it from the man himself. There's been times where he has put over 100% of his net worth. That just means he used leverage or margin. It's borrowed money. Kind of like right now I am with Alibaba. I mean, I always tell people I'm in 110%, so they're like, what do you mean? Well, because I'm 100% of my portfolio is in it, but I'm also using like 10% leverage or margin. And here it is, these guys talking about doing that. And another thing to note is notice how he's not saying 75% of your portfolio, he's saying 75% of your net worth. Your net worth is built off of a lot of different things. For example, it can have positive equity in cars, it could have different tangibles or assets that you own, or it can be your house. A lot of people's net worth, the most times, the biggest part is their house. So if you think about it, if you were to do that just based on the amount of money that's in your portfolio, it could actually be a lot more. Maybe 80, 90, or 100% of your portfolio. He's just saying 75% of your net worth. So hopefully that kind of made sense there. Just kind of wanted to throw that little detail out there.
No, there have been times, well, initially I had several times I had 75% of my net worth in one situation. There are situations you will see over a long period of time. I mean, you will see things that it would be a mistake. If you're working with smaller sums, it would be a mistake not to have half your net worth in. I mean,
notice how that key word, when you're working with small amount of money. I mean, these are things that I'm always telling you guys. And I just find it so funny when people try and rebuttal them because they think I'm coming up with them. But it's like, everything I teach and everything I'm sharing, of course, a very small amount of it is just things that I do on my own. But majority of it is things that I'm saying because I've learned them from guys like this. So I'm not just pulling things out of a hat, for lack of better words, not to cuss here. But I mean, there is just a strategic way and a path to making millions in the stock market when it's your passion and when it's your main work. Anyways, let's move on with the video.
You really do sometimes in security see things that are lead pipe cinches, and you're not going to see them often, and they're not going to be talking about them on television or anything of the sort. But there will be some extraordinary things happen in a lifetime where you can put 75% of your net worth or something like that in a given situation. The problem has been the guys that have put 500% of their net worth in. I mean, if you look at, just take LTCM, very smart guys, very decent guys, some friends of mine, high grade, knew their business, but they put, maybe 25 times their net worth into things that were a cinch if they hadn't have gone in that heavily. I mean, they were in things that had to converge, but they didn't get to play out the hand. But if they'd had 100% of their net worth in them, it would have worked out fine. They'd had 200% of their net worth in it, would have worked out fine. But they instead went to, maybe 2,500% or something like that. So
isn't it kind of mind blowing hearing someone like Warren Buffett saying it would have been okay if they added 200%? Sometimes that's what brokers like give out, like, oh, you can get, if you have $10,000, we'll loan you $10,000. It's double, and he's saying it's even okay if you do that. Sometimes, I'm sure he has never done that far. I'm hoping, but like, he's mainly trying to talk about the people who get super greedy and they're doing 5 times what their actual money is, or 25 times, like insane amounts of greed and leverage. But when it comes to like 100%, 70%, 110, 150%, it's okay to do sometimes. Let's go on because there's a lot more I want to share, but it'll be brought up later on in the video.
There are stocks. I mean, there's quite a few people in this room that have close to 100% of their net worth in Berkshire, and some of them had it for 40 or more years. Berkshire was not in the cinch category. It was in the strong probability category, I think. But I saw things in 2002 in the junk bond field. I saw things in the equity markets. If you could have bought Cap Cities with Tom Murphy running it in 1974, it was selling at a third or a fourth what the properties were worth, and you had the best manager in the world running the place, and you had a business that was pretty damn good, even if the manager wasn't. You could have put 100% of your net worth in there and not worried. You could have put 100% of your net worth in Coca-Cola. Earlier than when we bought it, but certainly around the time we bought it. And that would not have been a dangerous position. It'd be far more dangerous to do a whole bunch of other things that brokers were recommending to people.
Okay, so first thing, I don't necessarily consider myself, Berkshire Hathaway, like a... I just think Berkshire Hathaway is too diversified. You're almost diversified enough. Like, you are diversifying if you invest in Berkshire Hathaway, in my opinion, because they own so many different companies. Now, of course, there's smaller companies, kind of like Tencent, Alibaba, these Chinese companies, or Apple, Facebook, where you can add all your money into them, but they are kind of diversified within themselves. So it's not like just one product, I mean, they own many different companies inside of them, they have many different fields and categories. So in a sense, whether it's just one name, you still own a lot of different businesses within that main name, within the parent company, I guess, however you want to call it. So sometimes it's okay. And that's how I feel with Alibaba, I mean, people think I'm crazy for doing it, but it's like, okay, I'm kind of diversified because within Alibaba, there's so many different small companies. Even if one fails, a lot of them fail. So that's just one thing to keep in mind. Like, you have to understand that. And to an extent, it's even okay sometimes when they only sell one product, or like they only have one source of income because if it's trading below liquidation value, or kind of like what Warren Buffett just said, like, if they have a great management and they're trading 1/4 of what the actual money left over is, or like all that stuff, like, it's very safe. Like, it's and It's weird. It's funny because I say these things and people try and correct me. Like there's no such thing as a safe investment. Like, but when you understand the value of the investment, when you really did your research and you're completely cutting off speculation and you're going based just off the numbers and you know what it's worth, you're not worried about the stock's price. You can buy a stock at $10 because you believe it's worth 20 and that's what the numbers came out to. And it can go to $5 or $3. It doesn't worry someone like you. It's just time isn't on your side at that time, but it will come. It's just a matter of patience. So again, you have to understand what you're being involved in. Something I'll talk more about this later because I think he brings it up, but let's go on.
Charlie, you want to?
Yeah, the students of America go to these elite business schools and law schools, and they learn corporate finance the way it's now taught, and investment management is the way it's now taught. And some of these people write articles in the newspaper and other places, and they say, well, the whole secret of investment is diversification. That's the mantra. They've got it exactly back-assward. The whole secret of investment is to find places where it's safe and wise to non-diversify. It's just that simple.
That is music to my ears. And I try so hard to try and change people's mentality over this. Like when you find the perfect investment and like it has that low downside risk, the goal is to hone. And again, it would be a mistake not to add majority of your net worth into these investments when you truly understand them. Because what I was going to start still talking about, which you might bring up later again, is like kind of like when you don't know what you're investing in. I mean, to ask a question is to answer it. So if you're in an investment and you're constantly trying to like validate yourself and be like, oh, is this the target? Is this what it's worth? Should you guys be holding? What's going on? Why is it down today? Like if you're just panicking and looking at the stock every day and doing all that, you don't know what you own. Then that is a big mistake. That is just you speculating, you're gambling, you're betting on the stock. You're not putting your money in an investment that you understand what it's worth. You're not in control. In this case, the company or the stock's price is in control of you. Then there's a very fine line. And I think that's just what people don't understand. So when someone tries to argue this with me, I understand that either one, they're too new in the stock market, they just don't understand how things work, or two, they can be in the market for a long time, but like Elon Musk says and everyone else, you can be the smartest person with a very high IQ and you can still be an idiot. You can still be ignorant, and it does not mean you're in the right field. It doesn't matter how smart you are, how many books you've read, how many analysis stocks you've done. If you don't understand and it doesn't click, it's just you just don't get it, and you're not someone who will be able to do this, and like it's just not meant for you, which is why I recommend 99% of people stick to ETFs. Anyways, let's keep going with the video.
Diversification is for the know-nothing investor. It's not for the professional.
And there's nothing wrong with the know-nothing investor practicing it. It's exactly what they should practice. It's exactly what a good professional investor should not practice. But that's, there's no contradiction in that. A know-nothing investor will get decent results as long as they know they're a know-nothing investor, diversify as to time they purchase their equities and as to the equities they purchase.
So that's something you guys have heard me talk about on my Reddit post, on the 3-stage theory, and a bunch of other YouTube videos. There is nothing wrong with diversifying your money. You just have to understand that you're not going to achieve high returns. And you have to understand that you might be doing it because you don't necessarily understand what each company's worth. So you're diversifying because in case one doesn't work out, the other one will cover it. And if one runs, maybe one might go down. So they're overall kind of balancing and canceling each other out. But you'll kind of see that move up. You'll still see progress. You might not see high returns, which like a professional or someone who does this for passion or living like me is trying to aim. We're trying to aim for high returns. So it's a different strategy. It's a different kind of breed, I guess. But there's nothing wrong with just buying an ETF or just diversifying your money with multiple stocks. But I always kind of split it. If you're a doctor, if you're a lawyer, if you're a student, if you're someone who just doesn't have time in the stock market, like at all, then you should just stick to an ETF. Don't stress about the stock market. Don't get pitches from your friend. Don't try and copy others. Just buy an ETF that you like and understand, and just add money anytime you can to it. dollar cost average, or just buy as it goes up or down. Just keep adding money, and over time it'll accumulate. It'll compound. If you're someone who has a little bit more time in the stock market, but you're not necessarily trying to achieve high returns, then it's okay to diversify your money. It's okay to buy 30, 20, 10 stocks, 100 stocks. But just know that, you are kind of going against aiming for high returns. And if you're someone who's just really trying to make many, many millions in the stock market, achieve really high returns, you have the temperament and the stomach to be able to control a very volatile portfolio, because it will be volatile, especially if you're not as diversified, then that's what you need to be doing. Like Warren Buffett said, if you're trying to be a professional in that field, then diversification is a mistake. And it's a mistake not to add majority of your net worth in a great investment when that opportunity arises, and you will know when it's there. And it's came to me multiple times. It's what's helped me get to where I am. Let's go ahead and keep watching this.
That's crazy for somebody that really knows what they're doing. And you will find opportunities that if you put 20% of your net worth in it, you have wasted the opportunity of a lifetime, in terms of not really loading up. And
That's one major thing. Like when people are like, oh, I'm only putting 2 or 3%, but I know it's amazing. It's like, you're wasting your time. It's not going to move the needle. And if you really understand it, it's a big mistake to not take advantage of that opportunity.
We've had the chance to do that way in our past when we were working with small sums of money. We'll never get a chance to do that working with the kinds of money that Berkshire does.
Small amounts of money. I always tell you, it's a different ball game when you're in stage one and you're working with small money. And people, the funny thing is, people always try and study Warren Buffett's way now, but they are very unfamiliar and they don't understand the early Warren Buffett, which is what got him to hundreds, $300 million. And then he was able to transition to what he kind of does now, which is a different ballgame, which is what I suggest you don't follow. You shouldn't be following what Warren Buffett does now. You should be following early stage Warren Buffett and Charlie Munger. Let's kind of
try to load up on things. And there will be markets when we get a chance to from time to time. But very seldom do we get to buy as much of any good idea.
Well, that is the end for that video. That's really cool. I didn't know I can kind of backtrack this for like seconds. Anyways, that's the end of that video. I hope you learned something in today's video. I just wanted to kind of put it out there, for those people who just don't understand that it's not just me saying this. I've learned from these great guys, and it's not just them. You have other people like Seth Klarman. You have people like Howard Marks who have done this, John Templeton. There's mega billionaires that have been suggesting this, Mark Cuban and so many others. Anyways, I will see you guys on the next video. Make sure to like and comment, share this video, and let me know what you guys think, and just leave any comments or suggestions in the bottom. I will see you guys on the next one.